You wake up in the morning, brew your coffee, open up your favorite financial news app to check the headlines. Suddenly, you see words like market meltdown, stock crash, massive layoffs flashing across the screen in bold letters. You switch on the TV, watch a round table of experts predicting a recession, pointing the fingers at tariffs, arguing over whether or not the housing market is about to collapse again. If you're anything like me, you might feel a chill creeping down your spine, reminding you of the chaos we all lived through back in '07 and '08. But hold on, is that sense of deja vu actually justified? Or are we letting panic overshadow the reality that our world has changed drastically since the last financial crisis? 1 minute you'll hear the Fed is pumping the brakes to prevent skyrocketing inflation. The next minute you'll hear about mortgage rates inching higher and pricing out countless home buyers across the country. Suddenly, neighborhoods that were hot markets just a year ago are growing eerily quiet. Sellers are clinging to their asking prices. Buyers are holding out for a better deal, and everyone seems to be scanning the horizon for a storm that may or may not slam us like a sledgehammer. So what's the truth? Are we really on the brink of another housing burst, or is this just another bump in the road? My name is Darin Hunter, and in this video today, I'm going to break down exactly what's happening in our economy, how it compares to the infamous crash of 2007 and 2008, and whether our real estate market can handle the heat in 2025. Hey everyone, this is Darin Hunter, your mortgage and real estate expert located right here in Woodstock, Georgia. If you've been even mildly curious about today's market, you've probably noticed the swirl of headlines ranging from recession fears mount to housing market on edge. I know it's tough to figure out which talking head is telling it straight, including myself, which statistic matters most, and whether you should be making serious moves or hiding under a financial rock until the dust settles. In this video, I'm going to walk you through what's really going on in our economy in 2025, especially in the context of rising unemployment, stock market volatility, tariffs making a comeback, and GDP growth hitting the brakes. We'll also dive into why our housing market is so different from the one we saw implode in '07 and '08, even if some signs might feel strangely familiar. Plus, we're going to tackle the burning questions. Will mortgage rates keep climbing? Are housing prices about to plummet? And if there's a dip, will it resemble the carnage we all witnessed during the subprime mortgage meltdown? Or will it be a milder correction? Now, let me preface this by saying I'm not here to sensationalize or sugarcoat. I've been in the mortgage and real estate game for 20 years plus, and I've ridden the roller coaster of booming expansions and gut-wrenching collapses. I've watched clients make extraordinary profits and others lose the homes they love. The truth is, while certain warning signs are flashing, there's no crystal ball that can tell us exactly where we'll be in 6 months from now, or a year, or 2 years down the line. What I can offer you is a measured perspective drawn from data, from insider knowledge, and from the lessons learned the hard way during the previous recession. Let's start with the big R word, recession. Yes, unemployment has been inching upward, and yes, the trade policies and tariffs we thought we left in the rearview mirror are back in the conversation, placing new cost burdens on materials, consumer goods. Meanwhile, the stock market's mood is shifting faster than an Atlanta spring. 1 week it's bullish optimism, the next it's a sharp downturn that wipes out billions in the market value literally in hours and overnight. What really sets people on edge, though, is hearing about the America's GDP is shrinking or at least not growing at the robust pace we'd seen or we've come accustomed to. You'll hear a swirl of forecasts. Some economists say we might sidestep a recession entirely. Others insist it's just a matter of time. You might read a grim projection that in the next 12 to 18 months could see a mild or moderate downturn in the economy, especially if inflation remains stubborn. And the Fed keeps tinkering with rates to keep it under control. So how does all of this translate into the mortgage and housing markets? For starters, mortgage rates are still relatively high compared to the rock bottom levels a few years ago. If you remember the 2 to 3% rates from yesteryear, it almost feels like a rude awakening to see 6, 7, and even higher in the past here. Quotes are just high right now. These higher rates dampen affordability, which in turn calms down the wild buying spree we saw in 2021 and 2022. So yes, you have fewer home buyers competing for properties, and that can lead to sellers being more flexible, or at least that's what you'd expect. However, not all sellers feel compelled to drop their prices. In fact, we're experiencing historically low inventory. Why would someone give up a 3% mortgage and take a 6.5% mortgage for a new place? A lot of would-be sellers are staying put, and the shortage of supply helps keep prices from collapsing. Buyers, meanwhile, have lost some purchasing power due to the higher rates. This deadlock can create a stalemate where deals close only if the property is priced perfectly. Any seller shooting for the moon might see their listing stagnant on the market for months. But let's address the elephant in the room. Is this going to be like 07 and 08 all over again? The question is on everybody's mind. Back then, we had a perfect storm of subprime mortgages, minimal oversight, rampant speculation, and people buying properties they could not afford. We also had banks bundling risky mortgages into securities like they were hot potatoes, waiting for some unexpected soul to get burned. When everything unraveled, it was catastrophic. Home values plunged, foreclosures skyrocketed, and the entire global financial system teetered on the edge. Right now, in 2025, the lending standards are night and day compared to back then. Lenders are far more cautious today. If you're getting a mortgage, odds are you've gone through a thorough vetting process. The average credit score for approved loans is much higher than it was in the subprime era, and adjustable rate mortgages, which caused a good chunk of the meltdown when those rates reset, aren't nearly as common. Most homeowners lock in at a fixed rate, many of them near historic low percentages. That's entirely different ballgame from the ticking time bomb of the adjustable rate loans that triggered waves of default when monthly payments doubled or even tripled. Another aspect to consider is that homeowners in general have a lot more equity today. From 2012 through 2022, home prices soared in many parts of the country, allowing folks to build strong equity positions. Even if prices dip for a year or two, most homeowners are nowhere near negative equity territory. That means fewer people will walk away from their homes, fewer foreclosures will flood the market, and fewer distressed sales will slash neighborhood values. Now, don't misunderstand me. It's not all sunshine and roses. If unemployment shoots higher and consumer spending crashes, real estate could soften considerably. Buyers might feel too uncertain about their jobs to commit to a big purchase. Mortgage delinquencies could inch up like we're starting to see if enough households lose income. And if corporations start laying off workers en masse, that too will ripple through the housing market, particularly in regions that rely on certain industries. But the point is, we're not looking at the system built on sand like we were back in 07. Yes, we could see price corrections, 100% agree with that, 100% stating that, especially in the overheated markets, but the fundamentals are stronger than 07. Let's talk about mortgage rates in the short term. The Federal Reserve is juggling two main challenges. We still have inflation that's above target, though it's softened from its peaks, and now we have a sluggish GDP growth. Cutting rates aggressively might boost economic activity, but it also risks letting inflation run wild again. Hiking rates might help cool inflation further, but it could send the economy into a steeper slowdown. You can bet the Fed is watching every jobs report and every consumer price index update and every GDP revision like a hawk. My best guess, based on years of following the Fed's logic, is that they'll try to walk a middle path, possibly trimming rates if the job market weakens further, but they're not going to slash them to zero like they did in 08. For you, the potential home buyer or home owner looking to refinance, that suggests rates might gradually edge down from the current levels, but they won't dive down into bargain basement levels we saw a few years back. If a real recession sets in and the Fed decides to stimulate heavily, we might see more substantial rate cuts. Just remember, that's far from a guarantee. My general advice, if you find a home you love and the monthly payment is manageable, Don't fixate on nailing the absolute lowest possible interest rate. You may have the opportunity to refinance down the road if rates dip, but you can't always find the perfect property once it's off the market. To those who say the next 6 months to a year is too risky for any real estate transactions, I want to point out that life circumstances often matter more than macro projections. If you're getting married, having kids, relocating for work, or helping a parent downsize, you make decisions based on necessity, not just the ups and downs of the interest rates and GDP numbers. Timing the market can be a losing game because no one, not even the supposed gurus on cable news, can pin down the exact moment that's best to buy or sell. Instead, focus on the personal finances, your job, your security, and your future goals. Now, a significant part of the conversation revolves around the new wave of tariffs, especially those tied to manufacturing materials. If you're building a home or you're a contractor, you'll feel it in your bottom line. These tariffs can drive up construction costs, which can then push home prices even higher, or at least keep them from falling as much as you'd expect in a recession. If businesses pass these costs on to consumers, we might see a pinch in household budgets that reduces discretionary spending. Lower spending can drag down corporate profits, hurt the stock market, and possibly tip us closer to a real downturn. It is a domino effect. But notice a recurring theme. Our 2025 situation has multiple moving pieces, and none of them directly mirror the subprime fiasco back in 2007 and 2008. Instead, it's a blend of supply chain challenges, geopolitical tensions, and central bank determined to manage inflation without crushing the job market entirely. Compare that to 2008, when the major culprit was an over-leveraged financial system built on a housing bubble. Yes, these two periods share similar superficial resemblances like fear, uncertainty, and potential for a downturn, but the underlying mechanics are substantially different. Because of these differences, most analysts ranging from Bloomberg economists to various think tanks predict that if we do experience a recession in 2025, it's likely to be milder than the Great Recession of years past. Of course, milder doesn't mean it's painless. Some people will lose jobs. Some regions will experience steeper home price declines, and some businesses owners will find themselves in a precarious situation. But as far as the doomsday talk goes, the general consensus is that the next downturn, if it happens, won't shatter the housing market as catastrophically as the 2007 and 2008 did. To help you keep a level head, here are a few strategies I recommend for anyone on the fence. Number one, assess your financial stability. Before making a real estate move, get a clear picture of your savings, your debts, and job security. Make sure you can handle a few curveballs like an unexpected medical bill or job transition. Number two, stay flexible. If you're a buyer, keep your eyes on properties that have lingered on the market for a bit longer. You may find a motivated seller willing to negotiate. If your seller is in a softening market, consider pricing competitively right out of the gate rather than chasing the market downward. Number three, refinance if it's logical. If you bought your home when rates were lower, you might be in great shape. If not, keep an eye on interest rate trends. The moment they slip a bit, it might be worth refinancing, especially if you plan to stay in that home long enough to break even on all those closing costs. We're happy to help you with that. Number four, don't let fear lead. There's a difference between being cautious and being paralyzed by fear. Yes, watch the data. Yes, heed the economic indicator, but always remember that housing moves in cycles. People who time the market perfectly are just plain lucky. The rest of us do the best we can with the information we have. By now, you can see how complex our current economic picture really is. We've got higher than normal mortgage rates, a potential recession looming, a brand new tariff muddying the waters for businesses and consumers alike. Yet, we also have a housing market that remains relatively strong due to historically low inventory and more responsible lending practices. In essence, this is a standoff between higher borrowing costs and a population that still wants to own a piece of the American dream, but doesn't want to overextend or get caught in a bubble. So where do we go from here? If GDP continues to stagnate or contract and unemployment jumps significantly, we could see the Fed intervene more aggressively to spark growth, which might lower mortgage rates and give buyers a fresh hope. That said, any jolt of monetary stimulus could reignite inflation, putting us right back in the same situation we're in now. On the flip side, if inflation magically tapers off faster than expected, the Fed could pivot more confidently, making a soft landing possible and stabilizing the economy without a full-blown recession. At the end of the day, we have to remain nimble. If you're looking to buy a home, research your local market carefully. Each region has its own dynamics. In Woodstock, Georgia, where I'm based, we're still seeing a decent influx of buyers who love our community, but we're not exactly living through the feeding frenzy we had just a couple years ago. Sellers may need to sweeten the deal, but they're often still getting reasonable prices, especially if the house is in great condition, there's no deferred maintenance, and it's priced correctly. Remember, folks, the key to surviving and thriving in uncertain times is staying informed and having a plan. If you found this video helpful, please do me a favor, hit that like button, subscribe to the channel, and share your thoughts in the comments below. I'd love to hear them. I'd love to be able to answer any sort of questions about the housing crisis, or will this be a more gentle correction? What are your thoughts? Your perspective is valuable and it helps others see that none of us are alone in trying to make sense of it all. My name is Darin Hunter. This was another guaranteed video. Keep your eye on the shorter clips from this episode if you want a quick burst of insights to share on Instagram or with your friends who need a concise 60 to 90 second rundown of what's happening in the market. As always, stay smart, stay confident, and keep yourself one step ahead of this ever-changing world in real estate. I'll catch you on the next video. Until then, keep looking for the opportunities that surface, even when everyone else seems to be focused on the storm clouds ahead. Take care. We'll see you soon.